The investor presentation and the press release has been sent to all of you and is also available on our website. Our leadership team is present on the call to discuss the result. We have with us today Mr. Arun Jain, Chairman and Managing Director, Mr. Prabal Basu Roy, Advisor to the Chairman and Director on the Corporate Board, Mr. Manish Makan, CEO of IGTV, Mr. Rajesh Saxena, CEO of IGCV, Mr. Banesh Prabhu, CEO of Intellect Seek. Then we have Padmani Sharad Kumar, she's a Chief Talent Officer, Mr. Venkat Sarnu, CFO, and Mr. Andrew England, Full-Time Director. Besides, some other senior members of the Intellect management team are also present on the call. Mr. Venkat T will present you the deck, and then the commentary will be made by Mr. Arun Jain. On safe harbor, we would like to remind you that anything which we say which refers to the outlook of the future is a forward-looking statement. With this, I hand over the mic to Venkat. Venkat, over to you.
Thank you, Pravi. Greetings. I will very briefly walk you through the investor deck. I guess the investor deck and the PR are already with all of you. It's also on our website. It's on the stock exchanges as well. As we have articulated in several of the earlier investor conferences and calls, as a product, IP-led product and platform organization, our results are best viewed in an annualized basis. On that note, we will start with the reviewing the performance for the last 12 months, which ended on September 30th. For this period, our revenues grew 27%, moving from 1,640 crores last year to 2,087 crores this year. So on an annualized basis, run rate, we crossed that 2,000 crore mark in this when we closed this quarter. Gross margins moved up by 25% against this revenue growth of 27%. They were largely kept up, moving from 931 crores to 1166 crores. The EBITDA margin moved up by 9%, moving from 417 to 455 crores, while the profit after tax has remained flat, almost at around 311 to 314 to 311 crores. The gross margins, as the slide shows, is fairly constant, and the EBITDA percentage is 22% against 25% last year. Collections during the quarter have been healthy, so the last 12 months collection is around 1,905 crores. Going into the granularity of the revenue, we've in the past, in the Technology Day 1 and 2 sessions, which were hosted in 2021, we spoke about our progression from a products organization to a platform organization and perhaps eventually to a marketplace. So the platform, so the most gratifying metric that we would like to share is the stupendous growth in platform revenue. Platform revenues have grown 62%. They were from 276 crores to 448 crores in this. License revenues have remained flat. AMC revenues, which are driven by progressive go lives and installations coming on board, have grown by 11%. License link revenue is the other key metric that an IP-led organization like Intellect would like to benchmark itself on. That has again grown healthily, 20%, north of 20%. It's grown by 22% from 929 crores to 1132 crores. The other one is the annual recurring revenue, a metric that which we have been presenting in most of the recent investor meets, which is an assurance of future revenue streams. That's again grown well by 35%, moving from 587 crores to 790. Now, in the full year, the last 12 months, we had 41 wins, of which 14 wins were specifically in the last quarter. Look at specifically in the last quarter, our revenues were at 528 crores, which represents a 17% year-on-year growth compared to the second quarter of last year. Gross margins against the 17% growth of revenue moved up by 5%, moving from 262 to 276 crores. And EBITDA, there was a drop of 29%, moving from dropping to 84 crores from 118 crores. And PAT, we closed at 46 crores against 79 crores last year. The gross margin as a percentage of revenues is at 52% against 58% last year, and EBITDA is at 16% versus 26%. As I mentioned, the collections have remained healthy. They are at 472 crores in this quarter. The resultant day sales outstanding has been at 128 days, of which the DSOs for India-based customers is at 164, while for the rest of the world it's at 150. Again, looking at the granular view of the revenues, the platform revenue continues to be robust. It grew by 33% from 90 to 119 crores. License revenues are at 68 versus 86 crores in the corresponding period last year. AMCs, as I mentioned, for the last 12 months, it's grown at 10%. Based on the go lives, we had 14 go lives, digital transformations, which went successfully live in the quarter. So the AMC moved up from 81 to 90 crores. Licensing revenues grew by 7%, while the annual recurring revenue has grown by 22%. As I mentioned a while back, we had 14 wins this quarter, of which 9 are platform deal wins, which means more than half of the deal wins of this quarter are coming from the 6 platforms that we launched hitherto. As I mentioned, there have also been 14 new digital transformations where our MAC compliant architecture, our accelerators, our own technologies, and such such as iTurmeric and Canvas have helped us deliver at least 25 to 40% faster go live cycles. The revenue mix, the next slide gives the revenue mix in terms of the currencies. As you all know, the rupee has significantly weakened. We have a significant Indian rupee earning, which impacts the conversion of that into dollars. Similarly, the weakening of the European-based currencies, such as euro and the pound, where we hold significant revenue streams, also has impacted our dollar-denominated revenues this quarter. Looking straight into the future, the pipeline growth continues to be strong. There's a 36% increase in pipeline against the corresponding quarter last year, moving from 4,800 crores to 6,500 crores. In the recent quarters, we've more than the overall pipeline itself, which itself is growing. We continue to benchmark ourselves in terms of the destiny deals, which are the key deals above, as in the next slide, it's above 20 crores of value, which we track. The entire leadership team focuses on them. So that grows both in terms of the number of deals as well as the customers, the marquee logos that we get involved with, and as well as the average deal size. So as you can see, compared to a year ago, the number of deals have grown up from 54 to 66, with more deals growing in the higher tier of deal size, which is over 50 crores and 30 to 50 crores. Obviously, we're not articulated in this slide, but in the subsequent commentaries, we would hear that some of these deals are pursued with marquee logos as follows, and we are at advanced stage of evaluation or negotiation in several of these deals. As I mentioned, there are 14 wins this particular quarter, of which 9 were with Intellect platforms. As we have mentioned in the 2 technology sessions about our architecture, the 4 core technologies of Intellect, the accelerators, and the rich repertoire that we have of 300 plus packaged business components or user journeys, the open architecture with 900 plus APIs, which allows us to practically work with any ecosystem, integrate with any other technology partner that our customers, the banks, would be using, and the speed with which we are able to complete this integration, which is traditionally a big pain point in all implementations. These demonstrated capabilities and the referenceabilities that they provide help us accelerate the deal wins. Like I mentioned, 9 of the wins are in platforms. One is a Foresight, which is a major insurance client in the US, has chosen a full suite of underwriting, which is a combination of Magic Submission, Risk Analyst, and Exponent. You would have heard the data, our senior colleague Deepak presenting about the entire data cycle in the technology day sessions. So right from the stage of data uptake to data enrichment, to triangulation, to presenting decision grade information to the underwriter for faster and sharper quotes. So the entire cycle, the entire value chain of underwriting with an unparalleled accuracy is provided by this platform. Saudi, we mentioned as a focus on upcoming promising geography in one of our earlier calls. That is bolstered by one more win for the Cash Cloud. Cash Cloud was also a recently announced platform where we also had signed a partnership with Microsoft Azure. And that we won the second deal in Saudi Arabia. We have a win in Egypt for our lifestyle banking, where we had a award-winning a lighthouse kind of an implementation in the Middle East. So that is drawing more traction as we move along. ESG as always is obviously being the most trendy catchword, with a lot of investment bankers, a lot of financial institutions, investors, private investors, PE houses focusing on the quality of the ESG assessment of their target investments. To that end, one of the world's largest sovereign wealth funds has chosen our IESG platform, which is again driven by data and AIML technologies to implement this ESG assessment for all their investment evaluations. We had also one more insurance company win in North America for our Magic submission, which uses our Talk to API technology in conversion of structured and unstructured data into which could be readily used by the personnel in the insurance organization. So I mentioned briefly about Saudi earlier. We have one more win in Saudi for a microservices organization for a debt management platform. This apart, our products in the transaction banking and the consumer banking business continue to fire. So the core product-led deal wins, we had 5 such wins. One among the top 3 UK banks, where we already have a relationship that signed up for payments. Similarly, payments had its second biggest win with another Canadian bank, where we again have a very strong relationship. That relationship has been further deepened by a win. UAE has always been one of our most successful markets, and we had one of the top 3 banks we won for a mobility upgrade. The consumer banking business also won a digital core deal in Africa. Last year, you would recollect that we had mentioned about 3 large central banking deal wins in and around Africa. That winning streak is continuing with a digital core win during this quarter. And in India, we did mention 2 significant wealth platform deal wins last year and in the earlier quarters. That referenceability has helped us with one more win in this current quarter. So these are some of the deal wins. And I mentioned about the go lives. So totally we've had about 14 digital transformations going live during this quarter. And the next couple of slides, we have given details of each of them. So that sort of summarizes very briefly in terms of the numbers, our performance during this quarter. More importantly, as we always measure ourselves as an IP-led organization, how we have performed over the last trailing 12 months, what is in store ahead, what has been the quality, more importantly than the numbers that they've given to the top line, what has been the quality of some of the wins, why are they promising enough, and what message they convey to us, and what confidence they give us, and what has been our success story with some of the transformations, and where do they put us in our growth path. So that is a very brief summary. I would now hand over to our Chairman and Managing Director, Arun, to share his perspectives and give a larger view of the overall the market, the product technology scenario, and where we are in our journey at this point in time. Thanks.
Thank you, Venkat. Take the whole presentation deck at a very fast pace. So I'm sure the smart investor would have picked up all the numbers which you have thrown in the last 15 minutes. Looking at the numbers of the quarterly numbers, when you look at it, I feel that a lot of investors on the street would be disappointed. I acknowledge that disappointment based on the numbers which are there from the perspective of the quarterly results. But we consistently communicated that as a heavily focused license revenue company, which is adding portfolio of platform, it may result into few quarters where we will not be sure of the final number. And that was a kind of a perspective we always added to the communication with each investor conversation, that we can only be design our business on annualized basis, and on annualized basis, but Venkat put it 27% LTM growth. That's the right metrics. Now, this can get colored from the perspective of saying this quarter is a trend which is coming from few quarters like this, or this can be construed as a trend, whether we can trust the company for the future revenue or some analyst report on the street. That could be coloring the perspective from investor perspective. So let me just take you to the L1 next level detail of the results. The next level details of the result is switch off the presentation, no need of presentation. So next level detail says that we are shortfall by $6 million in a revenue numbers. So that's the underlying equation of revenue and cost. If we would have $6 million additional revenue, we would have been right number around 570 crore, and our cost EBITDA would have been 125 crore plus would have been the number from the $6 million. Now this $6 million consists of two elements. One element is when we moving from product to platform, there is a like-to-like license revenue. So like-to-like license revenue, we won 3 platform deals as announced by Venkat, and these 3 platform deals resulted into like-to-like license revenue of $2.9 million is the number which is coming like-to-like. So we measure internally 2-year ARR of the platform as a like-to-like license deal to compare license deal versus platform deals, and this 2-year ARR is what tantamounts to $2.9 million, and that's how we calculate our internal business plans and revenue streams based on that 2-year ARR as a part of MIS. Unfortunately, on accounting principle, there is a zero accounting or less than $100,000 accounting in the last quarter of out of $2.9 million in this for winning this deal. While the winning the deal, contracting, everything has been done, which is a very, very celebrating moment, which we are celebrating. Banesh and his team has done a wonderful job in getting this $2.9 million of a deal on this quarter. Second thing is, out of $6 million, $3.1 million is the 2 deals which are closed but not contracted, and this $3.1 million is already in the bag but not contracted, so it cannot be accounted in the quarterly results. So that's a story of the numbers from numbers perspective. Now, if I look at it from a qualitative perspective, the teams which is working in Intellect, I think we are surprised. We ourselves got surprised more than what market is expecting or market is trusting Intellect as. What is the surprises coming? So we are calling this as a wide window movement for internally for this quarter. In last 6 months, our journey which happened, it's a wide window movement for us, which is making us move from 2.0 to 3.0. What we spoke about in Technology Day 2 is all coming true within a 9 months of our Technology Day 2. It's very rarely happens when company is able to present something in December 9 to 2021, and what market is looking for is what we presented that time. So let me take you through each story of wide window movement, what we have. First area is we planned 3 units. One by one, we said GTB unit will go to the market first and take a product leadership where liquidity and DTB becomes the market leaders and take the market share. Then we said next 2 years, we'll look at GCB will take the major winning spree. Last year, you have seen the result, whatever the investment we made in GCB, core banking, lending, and winning the deal in central banking in quantum, all are driving towards the second wave. Third wave was Intellect Seek, which we renamed it to Intellect AI. The Intellect AI was the unit where we looked at it as a phase 3 of driving the revenue growth. And this year, in last 6 months, the platform deals, substantial growth is being visible in Intellect AI. We have merged wealth management unit also as a part of Intellect AI unit. So that's a combined unit is under leadership of Banesh is delivering the results. So first wave was Manish, second wave was Rajesh, third wave is Banesh. Now when we look at it, that our calibrated strategy is panning out in the same way as we projected in 2017. Again, that is a validation of our strategy that the company is performing as per the strategy, not by chance or not by market tailwinds or market headwinds. During this period, we had a Brexit, we have a Trump, we have everything happened during the period, but nothing has impacted the overall strategy and consistency of the strategy. Now looking at what we are seeing in the marketplace today. When we are winning the large deal from a largest fund from Europe on AI for ESG, what it means for a company like us as a technology company. They are highly invested company where each company has invested more than $150 to $250 million invested company in AI and data space. And against them, we are winning a deal on a complex topic like ESG, which is just an emerging topic, and winning the deal against all American, against all European competition. That signifies a wide window movement for us. It has not resulted into single revenue for this quarter, 0 revenue for this quarter, but it's a lead indicator, which is like we crack the Fabric Data Services AI algorithm of multi-question search, the moment of truth in the life when Google was there. So we look at it, when Google was doing a good search engine, they didn't have a revenues, but they had a algorithm which was great algorithm, and that's a great algorithm. We call it the wide window movement. And that is not about ESG or magic invoice or magic submission. There are 3 products we launched, but they are built on the same technology platform investments we made in last 5 years of our journey. And for each platform, the incremental investment is less than $3 million per platform. In last 6 months, this platform could be able to compose. As soon as we see the opportunity of ESG, within 6 months, we could be able to pitch in for the largest fund house of Europe and win the deal against all the competition. The second wide movement is when we are looking for wide window movement is when we are getting a large core banking space. Now, core banking space, we all know, is the largest, biggest market space. You must have read the market space size of $16 billion of a core banking space. This is published by Temenos in their results at how big is the market size. Till last years, we were contender in that space. Now we are getting to the leadership quadrant of that space. Now we are rubbing shoulder with Thought Machine, Temenos and Intellect are the 3 players which are rubbing shoulder on architecture, on APIs, on microservices, on cloud, and on depth of the product functionality. We are competing with the largest player. Now this space of $16 billion where the deal value multiplies, the size of deal value in our pipeline are running into double-digit license numbers, double-digit $1 million license numbers, and we are participating in those deals which we never participate in our 10-year journey. Those are our dream deals, or for dream deal for any company when you are rubbing shoulder with this player. So we are in the backyard of the competition, where in Thought Machine, which is led by Google ex-Google player in 2014, you must do a research on Thought Machine. The $550 million funding has happened on that particular company for building the core banking product, and still we are with head to head in 4 deals in Europe with Thought Machine, and similarly on Temenos, beating Infosys, Flex, Oracle, TCS, or Fiserv. They are 10-player market. So that's a second wide window movement for Rajesh. Rajesh and his team is extremely busy in bringing up POCs and POVs, and a lot of pre-sale investments are going in. Almost more than 8 deals in Europe we are participating over the period of time, and that's giving us a confidence of saying we can, on annualized basis, we can still do 20% of the growth numbers in rupee terms. The third movement is our creating a new opportunity window where we are saying consumerization of corporate banking. We created a space called GTB in 2014 when we started the business. We created a space called global transaction banking space, and that space then we could able to displace multiple players from 2014 onwards. There was a player called Mises at that time. There was a player called Funtech at that point of time. Now, this new space which we are creating called consumerization of corporate banking, just to understand from the perspective, there are at least 15 startups in this space, which is called embedded finance. Maximum amount of money which is coming in corporate banking space is in the space of embedded finance, where corporate banking is embedded with the final accounts where when the payment recon can happen. Like say if Coca-Cola is a corporate account of HDFC Bank, then all the vendor suppliers of Coca-Cola will also be part of the virtual network of the bank, and how do they participate over there. That is the consumerization. Uber, when Uber is an account and drivers of Uber drivers are a part of the virtual accounts, that's a embedded finance, and that is about consumerization, because the drivers of Uber is a consumers while Uber is a corporate, and that's the consumerization of corporate banking. This is a new space which we launched in Sibos. Last 2 years we were working in this space. We signed up 3 customers in this space before we are announcing consumerization of corporate banking, which is a third wide window movement which we are experiencing. The more than 25 leads got generated in Sibos within a small event of 3 days. And we are changing the narrative. In this, we are changing the narrative, and this is based behind one of the largest European deals from a UK bank, where payment space, which is crowded by a lot of European players. Again, the payments, corporate banking payment space is one of the largest invested fund in all the startups and fintechs. We are able to win the deal for one of the largest UK bank on the building the payment system for them. So all these 3 lead indicator, one on consumerization of corporate banking. Second is Intellect Digital Core, which is built on completely microservices, API, cloud native, headless architecture, where more than 300 APIs are working on it with more than 200 microservices, which we are combining core banking, lending, and credit card. And third is entire data space. These are like 3 different large funded entities within a one single ecosystem called Intellect Arena, equivalent to almost 3 companies. Each one has a potential to lead their own journey and fight the battles, and they're fighting. All the 3 are fighting because of the kind of a culture we created in the Intellect Design Arena, where all the 3 companies can go together in this space. All the deals, new deals sign up during this period are the indication 14 deals. So we are accelerating number of deals in coming quarters. We are well positioned to ensure that this license numbers can give us a good consistency going forward. And this is nothing new for us, that one quarter will go bad. We were I will not say we are sure of it, but any point of journey we were expecting such movement where one quarter can go, $6 million can go in one quarter, where $2.9 million goes from a perspective of moving to platform, and $3.1 million goes where the deal is closed, put boxed in, customer is convinced about it, and everything is there, and we'll end up into not able to contract before 30th September because date of auditors is 30th September to get a contracting done. So that's a story which I'm saying why we feel so excited as a management team over here. Now we are in window of opportunities which has opened up with this white window movement is phenomenally large. A lot of time we are spending in nowadays, more than 10 to 12 hours a day of our R&D teams or our sales teams, pre-sales team building POCs. It's a humongous amount of excitement in the behind the scene. So if you look at behind the scene, if you get an opportunity to see the BTS of Intellect, you will feel the pulse of what is happening at Intellect. And thank you for participating and attending in numbers for this call. So for us, it's a journey which we are very excited about, in spite of a slowdown or high inflation rates in the industry. How there is decision slowing down, some impact is there. So we acknowledge that the slowdown impact because of high inflation in Europe and low growth indexes over there is creating our cost structures because of talent are going up more than what we anticipated or planned for, and tax structure which is resulting into our lower PAT margins, since tax rate is moving from 16% to 26%. So there are 3 factors we acknowledge which are the market realities. But in spite of those 3 realities, we have 3 windows of opportunities which are led by our wide window movement. Thank you. We can open it for.
No, I think we can start the Q&A.
Yeah, please.
Now we are starting Q&A. In case you want to ask a question, please click on raise hand. I request you to click on please raise hand. First we have Mr. Mukul Verma. Please ask your question. Please unmute him.
Hello.
Hello, yeah.
Yeah, good evening, sir.
Yeah, Mukul.
Yeah. So this presentation, when we give that pipeline, so we give a pipeline comparing it to year on year. Can we can we put quarter on quarter as well? So one more column, so it gives us a clear perspective where we are moving quarter on quarter as well. Although we are looking at the company from a yearly perspective only,
Yeah.
but just to draw a point that quarter on quarter how we are moving.
We can give it.
That is one suggestion. So if we can do that, so we can know, okay, quarter on quarter how many deals have added, just to give that perspective. And so when you mentioned, so when you say that $6 million is something which could have come into the quarter 2, but could not come due to non-contracting and the platform thing. So we assume that this is a one-off quarter where profits have come on a lower end, and on a yearly matrix, we will grow at a 20% pace as we have been looking at. That's what I wanted to know.
That's right, Mukul. Exactly. This is a one-off quarter.
Okay. Great, sir. Wish you all the best. Thank you.
Thank you.
Thank you, Mukul. Next, we have Mr. Krishna Thakkar. Mr. Krishna Thakkar, I think it's from Anand Rathi.
Yes, sir, I have two questions. One, of course, is that 6 million follow-up. So, as I understand, 3 million you guys will possibly report in third quarter because it has already been signed. So, we'll get that extra revenue. But the balance 3 million is converted in, or is spread over 2 years or 3 years, depending, and then you will book only few thousand month or quarter.
That's
now, the point is, if that were to continue, do you think, given our high license contribution, and I'm expecting as you migrate more towards platform, there will be more shifts coming ahead. So structurally, your revenue growth for 1 or 2 years could be a little slower in this transition phase?
Yeah, that's true. I think that's exactly which will happen. That whenever, but what we need to look at it, we need to publish a number for this kind of a deal. So that's what we need to publish, separate number, that how many platform deals are getting signed and what is the kind of a ARR we are signing. So, but actual number, book number will be lower. So that's what we are now thinking about it. As of now, we have not made a decision. How do we communicate this platform deals to the investor so that they make a right decision?
Okay. And so possibly 20% may not be the right number to look at from a growth perspective, while you may do it this year, but from a longer time horizon, maybe 2 years, 3 years, we should be more conservative than that.
Yeah, in dollar terms, yeah, definitely.
And the second thing, sir, in terms of cost structures. Now, I am assuming when we plugged in your numbers, most of the costs are probably in line. It is only that revenue miss which is flowing through to EBITDA and to PAT.
Yeah, that's
now,
right.
In terms of cost, have we built in all the costs, or do you think this 3-4Q, because generally you plan ahead for the next year. So are there any incremental costs which we should build in for the rest of the year, or do you think costs will remain steady? And therefore that additional 3 million will not come with additional cost in third quarter?
Yeah, most costs are always built in on an actual basis. So cost we can't accrue and forward the cost. Cost is all built into this. But the incremental cost of the salary increment, as you know, we do a quarterly salary increment, not an annual salary increment. So those cost of the talent still will be there, but those numbers will not be significantly higher.
What I mean to ask is generally, like I've been following the company for a few years. So typically you build in the second half for potentially FY24. Sometimes you hire more salespeople sometimes.
That's right.
So I was referring to that one-time step-up cost. Is that something we should expect in 3Q, 4Q, or do you think cost structure is currently perfectly sized?
Yeah, what I'm trying to say is the cost structures from this perspective as of now, 443 crore is a total cost structure. Pre-EBITDA cost is 443 crore. It may go by some 2 million, 3 million per quarter based on the new talent requirement and new platform GTM. So those costs will be there, or POC cost. So these are the few cost numbers which will go up, but they are not in that significant number as what we had experienced Q1 numbers. We had travel costs and other costs, all of them went together. So now travel costs are now stabilized, infrastructure costs are stabilized. So it's only the talent increase cost will be the hit on us. Q3 we have a marketing cost also, like Cyboss and other things will be there. Few marketing costs up to 3 crore will be there. So these are the, but those are not natural cost which is there in the business. So no extraordinary cost.
Okay. And last was therefore, I mean consecutively, if my revenue growth is going to be 20%, earlier we used to have this outlook on margins of 23-24% wherever we end up. So should we assume that it is only a quarterly slippage and therefore 16-17% is not the recurring margin? And for next quarter we should be back to, from a full year perspective, when we project we should look at 23-24% margin?
It's difficult to give you an exact number, but it will be 20% plus for the full year.
20% plus.
For the whole year basis.
I think, sir, your last 12-month average, including the bad quarter, is 22%.
Yeah. Yeah, don't commit to something here. We'll try our best to have it.
16, 17, well, 20% should be the new base, is what you're saying, rather than going back to 24.
Yeah. So it can happen here, but we can't commit right now. 2020 is number 20% rupee growth and 20% margin growth.
Okay. Done, sir. Thank you and all the best.
Thanks, Mohit. Next, we have Sugandhi Sood from InCred. Sugandhi, please ask your question.
Yes, hello. Thank you for taking my question. I just had, a similar question on the growth, on the growth trajectory. And if you look at just the license AMC SaaS revenue mix, that there is a significant deceleration. Now I do understand, the extra color that you have given. But is there something structural that you're seeing in the market? Maybe it is on account of the, pressures you're seeing in your with your end customers, or maybe just the natural, trajectory that the business was to follow, because there was this sudden surge in implementation revenues, and that's bound to decelerate. So could you give us some color there?
Yeah, I think there are two things which I mentioned. One is a license revenue of 3.1. If you look at it, so some acceleration will be lesser. So around typically 11, 12, $13 million is a license revenue which signs. License revenue growth so you asked a structural question. The structural question obviously is because of the high inflation, the market environment. There's some structural delays happening on closing the deal. So last minute closure cycle times are getting elongated. So that's a structural issue we are facing. And that's an issue. We are not a different island than any other player in the marketplace. So we are sitting in the same island of technology companies, where some slowdown is happening on the technology investments as we move forward. Second change is license, AMC and implementation. Those numbers on quarter-on-quarter basis doesn't mean much of it. Look at it from the annualized LTM basis. That will give us a good indication, because AMC is growing 11%, which we expected around 11% number. So that is a license number growth will be 10%, 11%. That's a number we expect. Our core value as a company, which we have changed our trajectory from Intellect 2.0 to 3.0, is around platform. The platform is what is making a difference, and that's what the three wide window movements which I mentioned are those three units in any business performing at the same time is very rarely I've seen in my life that 3 out of 3 units are performing where we put a bet on. So that's what I can respond to your question.
And in terms of implementation with iTurmeric, I understand that your implementation cycles have shrunk. And does that have a role to play? Because we've seen a very strong growth in implementation over the last 12 months, or let's say 5 quarters. And is that something that one should factor in, and that implementation again would have a linkage with the pace of new wins? So is that a correct interpretation? I mean, in terms of your organic growth of revenues versus just the accrual of revenues over a shorter period because of the faster implementation.
Yeah, I think very good point you picked up. First of all, I must congratulate you that you are tracking the company so well, that you are even looking at the implementation life cycle. So that become my competitive edge, because my implementation cost for winning the deal will be lower because of Turmeric I'm using for reducing the cycle time, and this may result into the lowering of the implementation revenue. What we are trying to do now is that we want to participate in a more cross-selling propositions. So we identified 20 accounts where we are looking at to help them these accounts for digital transformation using our composable and contextual technology. And those revenue, as of now, get booked under implementation revenue. We will be looking at it whether we create a line item called digital transformational line item. But yes, implementation revenue will come down because if cycle time is coming down. So if I have a deal of $1 million, which I'm bidding $600,000 for license, so customer has a finite budget of $1 million. Now I'm able to do 65 to 70% on license and 30% to implementation. While earlier it used to be 50-50, or it used to be 45 for license and 55 for the implementation. So very well picked up by you, Sugandhi.
Sure. Thank you for that color. And in terms of your deal, if I look at the data that you give around Destiny deals, I can see that, across all ticket sizes, your funnel has seen very healthy accretion. But if I look at the pace of wins, that has been, more or less within the 4 to 5 1 quarter, excluding 4 to 5 range, and while the pipeline continues to grow. So, what is going behind? Are these deals taking more time to close? Is the size of deals or the nature of deals such? So could you just join the dots between the increasing number of deals in the funnel and the actual win rate? And considering that the commentary around competing with the top tier is very encouraging.
Yes, I think what happened now, the decision cycle has got 2 angles to it. One is a environment issue which delaying some of the decision, but second angle is with the cloud technology available, the way the client evaluate a vendor is changed substantially. Earlier, most of the deal we used to win based on the lot of presentations, lot of dance and drama on the boardrooms on the capability of the product. What is working in our favor is now on a cloud technology available, customer is asking for proof of concept, where they are taking a real-time scenario and they want to run on a system. So they have a longer cycle time. So when we first qualify under dance and drama session, so first of all is the proposal session, then there is a dance and drama session on the boardrooms on the technology and the domain, and now there is an actual real play which happens, which takes another 3 to 6 months, and that is where these deals are getting delayed. Rajesh can speak about it. How many, how much work he has to do for a single large deal. Rajesh, you want to share something?
So I think from a deal perspective, if I can put a little bit of the GCB context to it, I think Arun very rightly said that a couple of quarters and couple of years back, the deals that we were competing were relatively smaller, and we were fighting with smaller players. Now, as you rightly pointed out, we have moved into the big boy category, where now we are looking at some very, very large Destiny deals. And in these large Destiny deals, which cuts across, maybe multiple countries, multiple product lines, etc., the process of winning this deal, timeline that is required is much longer. And that is what is being reflected as you have seen in the data. A number of opportunities are rising because we are now competing with, let's say, from a core banking perspective, a Temenos or a Thought Machine. So the deal values are very high that we are chasing, but it is also taking us longer as compared to 4 or 5 quarters back when we were still competing with Finestras and Finnacles and etc. The game has changed a little bit for us, especially in markets like Europe.
Sure, that's helpful. If I may just add one more question on the cost structure side. So you did mention, call out the ESOP number in your notes, but within the software development cost, is that kind of the new base and will continue to grow? Are there any other one-offs? Are you including any, the employee cost for R&D? How do you allocate that between the R&D costs and this line, the software line item?
We are looking from last few years, our R&D budgets are $20 million. $20 million translates to 120 crore when it's 60 rupees. Now it's around 75 rupees. It's classed into 150 crore. So we are in the similar budget. So we capitalize. This quarter, I think we capitalized around 35 crore versus that. So which is same number as close to $5 million, less than $5 million, $4.54 million we capitalize on the R&D cost. Rest of the cost, which is for technology upgrades, we put into part of research and engineering group, and which is we take it the charge as and when it occurs. So this charge is around 40 plus crore for this quarter. So that's a total R&D spend, one of the lowest in the industry from that perspective.
Sure.
Yeah.
Sure. Thank you so much for the answer. Yeah.
Thanks, Sugandhi. Next, we have Mr. Vivek Charoria. Vivek, please ask your question.
Hi, sir. Thank you for the opportunity. So on the cost structure, you mentioned that we should expect another $2 to $3 million for the next 2 quarters. Will that be the new norm, or should we expect, say, after Q4 for it to slow down a bit? And in terms of the headcount, are we now at a 90 million run rate? I mean, now that we are moving some revenue from product to platform, I'm guessing that will take more time. But in terms of the headcount, do you think we are at the 90 million capacity?
Yeah. So headcount is almost there. I mean, we still needing more headcount on sales and marketing side. Because platform, we need to build up a capacity in the sales and marketing side. So that it's not in headcount terms, but it will be in the qualitative higher cost inputs will be there from the perspective of looking at it. $2 to $3 million cost increase with a kind of talent. Let's see how the market stabilize. Then we can comment on it. But as of now, for next 2 quarters, this number is visible to us because of whatever the raises they get in first quarter and second quarter, third quarter and fourth quarter has to be in line with the raises are related to the first quarter and second quarter.
Sir, and in terms of, so if we were expecting previously to hit $100 million run rate in the next 8, 10, 12 quarters, do you want to now stretch that? And do we still hold on to the 30% margin target at $100 million, or we need to scale that back by a few points?
Let me not comment on it as of now because the market is too volatile right now, and this fluctuations are too much right now. So this quarter will not be right time. Maybe another give 3 to 6 months, we can come back onto that number of 2 to 3 years. But $100 million, reaching $100 million in 8, 12 quarters, I think that is we are quite confident about. On the margin side, we just need to look at it, the market volatility.
Sir, and you've mentioned that you're still confident about hitting a 20% growth for this year. Is that dependent on us signing a few big deals which are in the pipeline, as Rajesh had mentioned? Because if those don't come through, the numbers might drop down significantly. Or are we reasonably confident that those will come through?
We have not taken those into account in this 20% on rupee growth.
Okay. So
we are not taking into account.
Okay, so you've not taken those big deals when we talk about a 20. So previously we were talking about a 20% dollar growth run rate. I mean, has there been some change in the market? Or I mean, because
obviously there's some change in the market. I think we need to recognize that some slowdown is happening. So this slowdown has resulted into dollar number on. So we always mention to you is that we are designing a business for 20%. Last year we did 26% in dollar terms. But I constantly kept on saying, a lot of time investors were saying, why shouldn't you grow more than that? We say 20% plus minus 5% is a kind of it can happen because of market scenario. And that is what exactly which will happen in this year.
So just one more. Sorry.
Yeah. So if we win more deals, it can be much more closer to 20. It may be closer to lower end of the 15.
So just one more qualitative question. On the one hand, we keep talking about the fact there's a slowdown in the market, and then we are pressing ahead with so much of investment. Don't you think we might run into a wall where we've bloated up the cost structure, but the revenues aren't coming in? Or are you reasonably confident that with the headcount increase, I mean, there's enough business to be had? Because, I mean, I can't square the two together, where on one hand, we're talking about a macro slowdown, and the other hand, we are increasing the pace of investments.
I think you should companies. I'll give you the indication. There's a company called Modern Treasury.
Yes, I mean, they signed up a deal with Goldman Sachs.
Okay, so there's a company called Modern Treasury. They are getting a, Manish can share the color on it. And there's a company called Thought Machine. So if you just study these two companies, that what are they seeing? The new investors which are coming at a valuation of Thought Machine at $2.7 billion for $50-60 million revenue company. What are they seeing the market size in core banking space? That what is the kind of inefficiencies are sitting on core banking side in Europe and America, which is leading to that. Similarly, what is the opportunities in Modern Treasuries in a same space as consumerization? So Manish, you would like to put a color on it?
Yeah, they're also about 27 million revenue and between 2 to 2.5 billion market cap. This is primarily because the TAM being very high, and this is based on volume of transactions. The whole platform banking as a service which we have launched, this is based on a transaction value, volume, multiple similar parameters. We're also competing in North America, the same market. Number of these individual fintechs are running. I think the difference between them and us would be they are borrowing someone else's money and burning it out. We are organically funding and competing and winning against them. Our base assets were strong, that tuning it for the right market segment, we could do it at a much lower cost. Like Arun said, where we might look at is on a sales marketing some of the costs, but from a product readiness, the composable nature of our products, straight away we are able to get in a segment where they're more happening. And the TAM on, if you look and study the TAM on embedded finance in general, both on consumer and corporate, the numbers are in $1 trillion. This is a new segment which is happening, and this is where growth is happening very significantly.
Okay, sir. Thank you for that.
Thank you, Vivek. Next, we have Mr. Harshil Setia for AUM Advisors. Harshil, you there?
Hi, sir. So I want to ask, so our operating cash flow for the first 6 months is at 45 crores. So, and it was 94 crores for the same time last year. So what has happened in the first 6 months that our operating cash flows have reduced? I see that our DSO days has increased by 13 days in the first 6 months.
I think this operating cash flow coming down is basically on a bonus payout. So bonus payout is higher this year. So dividend is not a part of operating cash flow maybe. So operating cash flow is a bonus payout for the last year we grew very well, close to 27% we grew last year. So the bonus payout was higher than the previous year on that basis. Collection is same as 460 crore last quarter and 460 crore this quarter is in same line of business. And salary costs are higher in this year compared to the salary costs were there in the last year. So yes, there is a marginal drop, but this is the two places: salary cost increase and travel cost increase compared to the last year, where travel was not there last year same time. And the third is your bonus.
And so my question for the DSO days that it has increased, so for which was ex-India 95 days 2 quarters back has gone to 115 days currently.
This fluctuates quarter. I think this is it will come back once we get a advance payment, we get some large deal payment, some closure of the project. So this 10 days here and there is fluctuating in a product business compared to the services business.
Okay, so what would be a standard sustainable range of DSOs?
We try to look at it between 115 to 125, which fluctuate on an overall basis. So it goes to 120 plus, it come down to 1 plus 16. So if you look at it last 16 quarters, you'll have this fluctuation in the same range.
Okay, thank you.
Thanks, Harshil. Then next we have Mr. Ravi Mehta from the
I just want to
Financial.
clarify, Praveen, I want to clarify some of the investor reports which is floating around unbilled revenue, that unbilled revenue is a fake revenue. I think some analyst has looked at it as if unbilled revenues are a fake revenue, and that is projected in an investor report. We got very hurt with that kind of a non-knowledgeable people sitting in doing the analyst community to say that unbilled revenues are not appropriate. Unbilled revenue is the nature of the business. So if somebody has to write a report, he should talk to us that what is the nature of the business is there. Our nature of the business is that when we sign the contract, we have some commitment of business outcome based deals we sign. Based on that, when we completed the outcome, we bill the bill to the customer. But whatever the efforts we put in during the building the solution for the customer, when the customer is not achieving the milestone, it lies into unbilled revenue. Unbilled revenue is not a new phenomena. It's always happened in many civil contracts. When the building has to be constructed, there's a huge amount of unbilled revenue will be sitting in a books of any work in progress business. So that is the one point since you mentioned about the DSO days. I just want to cover up that point because I received some of the calls after the report got published that somebody is looking unbilled. Why won't you give a clarification? I said, I don't need a clarification for anybody when we are doing the right business in this area. Okay. Next question.
Yeah. Thanks, Arun. Next, we have Mr. Ravi Mehta from Deep Financial. Ravi?
Yeah, hi. Am I audible?
Yeah, Ravi, please go ahead.
Yeah, just two questions. One was on the pre-sale investment, because looking at the larger deals and also the POC involved in platform deals, what kind of pre-sale investments, if you can share some number vis-a-vis what we used to do, because I think the margins what we see captures the pre-sale which wasn't that high earlier. So maybe some color around pre-sales investments.
So if you look at S&M investment, which is close to now 150 crore for this quarter, so it's around 600 crore. So pre-sale is embedded into this particular cost of S&M, and which is grown by 7 crore from last quarter to this quarter. So that's the kind of a pre-sale investment which is booked. So they are not capitalized or anything; they are just expense out.
Sure. And also one more question was that in this quarter we signed 9 platform deals out of the total 14. But the platform revenues, the subscription revenues are flat Q-on-Q. So just wanted to understand the cycle as to when you book a deal, by when we see the revenue flowing into the subscription line item.
Typically, it takes between 3 to 6 months to get a flow in, because when somebody starts consuming the platform, the payment starts from the day when he's consuming the platform. So the initial product business, which used to call in implementation, so we used to have 2 revenue streams earlier. We used to have a license booked on the day of looking at it, and if you have to make somebody live in 6 months time, then 6 months was the implementation cycle time. So in platform deal, we have reduced the cycle time of going live. In some situation 2 months, some situation 3 months, some situation 4 months, so depending upon various platform when it become live, the platform revenue get booked.
And there won't be any implementation component when the platform deal is going live maybe in 2 or 3 months.
In few cases it's there, few cases not there. So it's not a normally if it is a standard platform, no changes are there and just onboarding of the customer, so then there's no implementation charge. But there could be setup charge for certain large customer. We may have a setup charge for him when we are onboarding a customer and he has some specific requirement for building the using the platforms. Like if largest financial services company of Switzerland, if they start using our platform, then we need to integrate their platform with their security structures, their cyber security issues, and we need to spend a lot of time with it. That time customer pays us a setup fees.
Sure, that helps. And just one small follow-up to the clarification you just gave prior to my question regarding those DAs, unbilled revenues and the DSO days. Just wanted to check that the unbilled portion was increasing pretty sharply in last few years. So is that a function of the cloud business, the platform business? Is it a function of that?
Yeah, I think there are two kind of functions of that. One function of this unbilled related to the contractual payments in it, where we sign a 5-year deal where we have to book the revenue based on the accounting principle on the date of booking the deal, and then the contracted payments are annual basis. So some of the deals in a cloud nature where we sold a license, we are accounted the deal on the date of booking the contract. That delays that increases the unbilled component. Second is more and more customers are now looking for outcome-based deals, outcome-based deliveries. So major milestones payments are not equally proportion every 3 months. They are linked at a time of UAT sign-off or when business is going live, because of which the market situation is changing from that perspective. So there are two factors which are resulting into higher unbilled revenue.
Sure, that answers. Thanks. All the best.
Thank you.
Thanks, Ravi. We have next Mr. Rahul Jain from Dolat Capital. Rahul, you are there? Please ask your question.
Hello.
Yeah, Rahul, please go on.
Is my line fine?
Yeah, please go on.
Yeah, just two questions. Firstly, on the business side, I mean, is there a way that we should now look next 12 to 18 months little different than how what we were perceiving on the demand scenario, and what aspect of the business in terms of the segments, multiple segment we operate should see a behavioral change in terms of the customer spend? Any color on those front end, a base case demand thought process, if you could share, assuming that macro is uncertain. I can understand it's very difficult to compute a number for next year sitting today, but any base case number one can go for from a next 12-month perspective, that would be an additional color. If we could give in any form, that would be of help. Thank you.
Rahul, the three indicators when we say white window movement for us, I'll ask Banesh to look at it, the opportunity that what he's seeing in the data opportunity. Data is such a big space emerging. So fortunately, our technology day was a path-breaking day. December 9th, when we presented the technology day to all of you, I think you should go back to those presentation decks. We were expecting that to come true in next 2 years when what we presented in technology day 2 in December. Within 9 months, we are seeing that those are becoming reality. Those are from product to platform to marketplace. The companies which are struggling are those who stayed in a product business. Since we took a journey almost 18 months back, we are able to see some windows of opportunities, but for many product companies will be in a struggling phase right now. So Banesh can share the data opportunity what we see, because the underlying platform of Fabric Data Services and Doc2 API, ability to create new platforms which can compete in a new emerging scenarios in next 2 to 3 years. That capabilities are there. Then Rajesh, composability is there. So the product we are selling in a market is not the standard products. With composable and contextual technology, 2 frames which you use, composable frame to create a new products and contextual frame for a data perspective. Both the frames are panning out so beautifully for us. Over to Banesh.
Yeah. Just to add to what I think Arun was saying earlier, the data platform that I talked about at Technology Day, along with another colleague of mine, Deepak, I think the data platform is being a big differentiator for us in the US, where we've launched it from an insurance perspective. Now we've touched on the end-to-end life cycle of just to take stock again, the insurance platform that we run for commercial lines insurance is fully on AWS on the cloud. It's a 100% subscription business. Now, within the subscription, customers are clearly paying a license component that is paid over a period of time, and some of the subscription revenues are actually sticky for a lot longer period. So what we're actually seeing is a significant number of customers, and we've had some very good traction in the last 2 quarters, both for the data platform that we use, which is using a product which we call Risk Analyst, along with our Magic Submission platform. This is where people submit a lot of documents for commercial lines, different commercial lines insurance businesses. So Doc to API, which is the platform that actually is the core platform that extracts information from insurance companies' documents, and these are pretty large set of documents, quite complex. This is not just extraction of data, but we have a lot of AI technologies that pull information. So it's actually achieving a operational efficiency for the client in such a way that it is almost a low-touch operations model. So it's quite efficient for a customer to take a submission from an email, extract it, and convert it to APIs, have data platform that we have, which is FDS, which enhances the data quality on the submissions, does some validations of the submissions, and passes it to the underwriter on the underwriter workbench, which is Exponent, to fulfill underwriting very efficiently.
Yeah. I think we are addressing more on the technology aspect of it. My question was more from the sense of that I think our use cases are pretty much proven in terms of the kind of customer we have got onto those kind of product. Where my question is more, I mean, your insight would be more of help in terms of how we see some of these things become scalable, because some of these products like Risk Analyst, we've been hearing for more than 5-6 years now. So I know the market has evolved, your use cases has evolved from insurance offering to a much different set of offering. We do understand those things, and I think you have, as an organization, have delivered much faster growth than most of your peers in the space. So I think those parts are well addressed in your bigger events and all. My simple question right now is that some of this right positioning of the product, be it on the cloud, be it on the otherwise on-premise model also, with these offering, where we stand today in this current environment, because this is probably as per various analyst thought process and all, probably the first down cycle in the potential down cycle of a banking sector that we may see ever since we came into public, right? So from that perspective, should we see anything to look into from next 12 to 18 month perspective versus whatever we have delivered on the last 5 year CAGR basis? Is that the number we can still stay as from our thought process perspective, or should we see in a different light given the macros that we are facing right now?
So Rahul, hold on for 6 months. I think that this volatility is there today. So in 30 September, a pound went down to 1.03. It came back to 1.16. So this volatility of 10% in the market we never seen in the past. I think it will be better to comment. We are able to see at least up to March right now on exact number what you're judging. We are on a cutting edge, and these technologies are required. And we are seeing the momentum of the investments coming from in spite of the downturn of the startup investment, but in these spaces, what consumerization of corporate banking, the core banking investments are coming there. So it means the market opportunity is there. How exactly, how much percentage? Wait for 6 months, maybe we can able to communicate to you during the annual cycle of the communication.
Got it, sir. Thank you and best of luck for the time.
Thanks, Rahul. Arun, over 6:15. Can we take few more questions?
Just one more question, yes.
Okay. Next we have TVK Kumar from Westfall. Mr. Kumar? Hello? Mr. TVK Kumar, you are there?
Okay, he's not there.
I think he is not there. So next,
Sir, are you there, sir? Sir, are you able to hear me, sir?
Yeah. Mr. Kumar, yes. Please go on.
So no, sir, you were told about this digital core banking that we are competing with Temenos and Thought Machine. Have you won any deals, or you're very sure? So what is the essence of what you are seeing in that? Are you sure that you will have a reasonable market share? Because you are saying this is a new thing that has opened up for us. So can you just throw more light on that? That was the thing. Thank you.
Yeah. So I think let me answer that for you. I think when we look at a large player looking at a core banking transformation, and this could be a large player with multiple country business, they start with a long list, right? And that long list could be 10 to 12 of your 10 to 12 of our peers / competitors who are in that long list. And as we go through the process, we go through various stages, and what we are seeing, and that is what we summarized for you, we're saying in a couple of in 4 deals in Europe, we are right now in the last 3 stages. And what are we seeing there, right? And what is very interesting for us is that we see Temenos there, and we see Thought Machine, and we see Intellect there. I think that's where we are saying that we feel confident that large tier bank, and when you say large tier bank, if you understand their buying mechanism, it goes through functional, it goes through technical, it goes through their architects, it goes through their cloud architects. So I think it's a very thorough process. And for us to make consistently from the long list to the short list and be in the last 3 for a couple of these very large deals gives us the confidence that our technology is the market leading technology. And I think what we have said earlier, which is MAC, right? Microservices, API and event driven, cloud and headless, is what is resonating very well for us in markets like Europe. That's why we feel cautiously optimistic that in these deals, we may not have won any deal, because if we win any deal, this will have a significant impact on our revenues. But we feel reasonably confident that our product is well matched to our competitors or peers, these 2 competitors that I talked about in this market.
So we will be announcing any deals in the next. When will we know whether we are?
We are all waiting for it. Yeah.
I wish we had the crystal ball.
Okay. Yeah, that was my question. Yeah. Do you have the crystal? Okay.
Yeah,
go ahead. Thank you. All the best.
Thank you, Mr. Kumar.
Thank you.
Yeah.
Thank you, Mr. Kumar. So thank you everybody for participating in today's call. There might be few questions which because of the paucity of the time we were not able to take it. Please do write to us with your questions, and we'll answer you and mail you back. Thank you so much. Now we can disconnect. Now we can disconnect.
The recording has stopped.